Charlie Munger and Warren Buffett basically say, we don't care what the market environment is. We care if it's a great business and we can buy it at a great price. And that's exactly what you're doing. Where are we right now in this crazy economy, stock market, et cetera? We're going to go over some different things. We're going to go over inflation, jobs, CPI, PCE, consumer sentiment, et cetera. So right now I have on my screen, this is the consumer sentiment number that came out today. So a survey of confidence, this is from University of Michigan, fell to a 3-month low of 102.9 in February, signaling worries about high inflation, higher interest rates, et cetera. The closely followed index fell 3.1 points from 106 in January. So they were forecasting actually a growth, but there was a shrinking. So 108.5. What does that mean? Well, I tend to ask my audience on the morning show all the time, and I kind of just say, hey, this is an important one. Do you personally feel, and this is going to inflation, do you personally feel that you're spending less or inflation is coming down? And the general consensus always is about 85% of people say, no, it's not. So I think that's a pretty good survey of saying where consumer confidence is right now in the cycle. Now, I will say our audience is probably a little bit skewed because they tend to lean towards the more of the market is going to get worse before it gets better. But it is a survey that I do frequently about once a week. Looking at inflation. So CPI data, this is a core number. When you look at February, it came in at about a 0.5% increase. And that was rising 6.4% year over year over the last 12 months. Not a good number. Then the market kind of shifted and people said, let me put a timeline in place. So what happened was the Fed came out on, what was it, February 1st or 2nd or something like that. And they said, we're going to do a 25% basis point increase. And looking forward, yeah, we're going to increase rates a little bit, but it's not going to be anything crazy because we do believe that inflation is kind of coming down. It's not stopped, but it has kind of started to tailor itself down, and we're comfortable with 25% increases, and probably towards the end of this year, we won't be doing any increases, and we'll just stay around that 5% number for the terminal rate. Okay? 4.755%. Then CPI came out, the number that I just told you, and people started saying, oh, maybe inflation is not as under control as we think. You had James Bullard. You had Raphael Bostic, the one Fed president out of St. Louis, one Fed president out of Atlanta, respectively, and Loretta Mester out of Cleveland. She said, maybe we have to be going towards that 6% terminal rate. Then the PCE number came out. That is what the Federal Reserve looks at as the main driver of where inflation is going. It's their biggest indicator. And it rose for the biggest rise since last summer, 0.6%. And that was a big number where markets started to fall, and that's when the talks of, hey, maybe we need to go 50 basis points again because inflation is not getting controlled. The worry about interest rates started to climb again. When you looked at the futures markets, people started saying, oh, maybe we're not going to be around this 5%. Maybe Raphael Bostic, James Bullard, and Loretta Mester are all right saying that we're going to go towards 6%. Then you had Jerome Powell come out and he said, yeah, maybe we're going to have to get a little bit more hawkish. He didn't say that in so many words, but hawkish and dovish are their two words. So then you look at jobs. Unemployment number is very low. And this is something that the Fed continues to harp on. They say that we need to get rid of jobs. We need to control the labor market. We need the labor market to get worse. We need spending to get worse. That's one way that we're going to bring inflation down because right now, people are still spending. Credit card debt levels are at record highs. That means that people are still spending their money. That does not help inflation. Unemployment level is extremely low. That does not help inflation. So for the Fed, what choice do they have right now? They have one choice, and that's raise interest rates. But they cannot raise interest rates too aggressively because they don't want to disturb the stock market. We've already had a very, very steep decline in the stock market. Let's pull up SPX right here. So this is the S&P. I'll just pull up SPY. There we go. This is the S&P, and you can see the chart. Let's just look at the 5-year chart, and I'm just going to draw a very gradual line. It is coming down. It is coming down off those highs. They do not want this to continue on. And if it can be even more dramatic if I just draw the 1 year. You can see that you have these peaks and then it falls, and then these peaks and then it falls, and then these peaks and then it begins to fall. So they're between a rock and a hard place. They need to control where the market is going, market sentiment. Plus, they have to kind of decide where they're going to go with rising interest rates at their next meeting, which is in mid-March. So the real question becomes, you hear all of this and you say to yourself, well, what am I supposed to do? And I look at it the same as for myself. I say, what am I supposed to do? I mean, you can't control it. You can't control inflation. You can't control interest rates. All you can control is what is in your control. That's your house. That's your investments. That's your family, etc. So I go at it from three perspectives. I still try to find really good investments because at the end of the day, and I'm going to pull up Google here. When I'm looking at a company like Google, and I know a lot of you that are watching this channel are value investors, and if you're not a value investor, pay attention to this. I look at a company like Google and say, okay, I do think that this is a company that I want to buy and probably around these prices. And looking out long term, I want to own this thing for 10, 15 years. I think this is a great company to own. Do I really care what the market environment is right now? If I bought today Google at $90 and it dropped to $75, what would I be doing with Google? Would I be selling it? No, I would be buying more of it. Or I would just be, if I was fully invested, I would just be holding my position. Because I think that Google in the future is going to be a hell of a lot more than $90. And to pretend that I can control and predict where PCI is going and CPI is going and consumer sentiment and where the market's going to go, it's not going to work out for me. So what I'm going to do is I'm just going to go buy a good company at a great price and let it go. Because those little shifts in dollar amounts here and there, yes, they could add up over time. Don't get me wrong. If you buy a bunch of companies and they all drop, say 20%, and then you have to recoup that 20%, then you need to start making money on top of that, yeah, it's going to burn you over time. But if you're buying really good companies with great balance sheets, great income statements, great cash flow statements, and great businesses, they are going to recover faster and they're going to fall less. Number two, I like to trade. And the reason I like to trade is so I don't get too involved with all of these value stocks, and it just keeps me active. It keeps me doing stuff. I also do options for that reason. I keep myself busy in the market because it keeps me out of the FOMO. It keeps me out of the noise of CPI and PPI. If I didn't do the morning show, guys, I wouldn't look at the news, period. I don't care what's in the news. I do it for entertainment purposes. I could go to Market Watch right now and see what the headline is. Buying stocks today is just as risky as is not worth the risk today. I think that's stupid, because if I can go in there and find a phenomenal stock like Google for $90, $80, whatever, that to me, looking out 10, 15 years, I'm going to get a hell of a return on that thing. And that is a stupid headline. So that's just an example. You can go through all the headlines you want, and they're really dumb. Number two, number three, number four, I don't know where I am. You need to save. We're going into some type of recessionary environment. Save as much as you can. Put as much as you can into your Roth IRA. Put as much as you can into your 401k. After you max those out, put as much as you can into your brokerage accounts. That is the best way to attack this type of environment. And educate yourself. Read. Read from some of the best. Read from Buffett. Read from Mohnish Pabrai. Read from Charlie Munger, Joel Greenblatt. These guys have experienced it before. You don't need to get swept away with the news of the day, the talking heads on television. You need to look at it and say, hey, it doesn't matter what environment I'm in. It doesn't matter where things are going. I need to stay focused on my job, make good investments, make good trades, make good options trades, and save. And that is the big thing about this. Charlie Munger and Warren Buffett basically say, we don't care what the market environment is. We care if it's a great business and we can buy it at a great price. And that's exactly what you're doing. And if you're somebody that doesn't go out and buy individual stocks, month in, month out, year in, year out, quarter in, quarter out, whatever your plan is, go and buy SPY. Go and buy Vanguard ETF. Go and buy your ETFs and just keep religiously doing that. Don't try to time markets. I get the question too often that people say, Mo, should I take my money out and kind of wait for the market to pull back? What if the market never pulls back? Then what? Then you're just screwed. Then you're buying way up here. I mean, I do think it's going to pull back, but you never know. The point is, do not time markets. Do not time markets. Guys, if you want to be a part of our community and talk with tons of people about this, look, I have 6 notifications I need to go and answer. Come in, $7 for 7 days. Come in, try the software. You get the tool, all the tools that we have. Retirement calculator, it's very valuable to you. telling you if you have enough money to retire. 8-pillar search, pillar screener, exclusive content from Paul and myself every day. Stock analyzer tool. You can go and see what you want to pay for a company. $7 for 7 days. And if you're interested in the oracles of EM, deeper dive, learning trading, learning options, keeping yourself busy, keeping yourself out of the FOMO. 7 days, $17. Come try it out. You guys have a great day.